This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Asian stocks set for gains as cool U.S. inflation data eases concerns about imminent rate hikes. But Fed Chairman Kevin Warsh tells lawmakers the central bank has more work to do to tame prices.
There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view.
Oil holding near a one-month high as President Trump drops planned cargo fees in the Strait of Hormuz while the U.S. resumes its blockade of Iranian shipping. And IBM plunges the most since at least 1968 on a quarterly sales miss blamed on the AI-fueled chip shortages.
I'm Avril in Singapore. Here's the setup for trading across Asia. Of course, we are focused on how energy prices remain elevated with these strikes resuming on Iran. And as the U.S. has told us, those blockades on Iranian ports are also resumed. We're looking at Trump also threatening civilian infrastructure next week in Iran. Take a look at where New York crude is pointing, nudging closer to the 80 handle. We're, of course, also watching out for the market's continued reaction to Chairman Warsh's comments on the Hill. He doubled down on fighting inflation, but the takeaway for market seems to be that there was any lack of fresh hawkish signal from his testimony. We had U.S. inflation data as well, both on the headline and the core print coming in softer than expected. So traders dropping their bets on a Fed hike this month. That played out in a massive rebound on the front end. We're looking at that as a good setup for Asia stocks. Maybe track what we saw in the U.S. overnight, where banking stocks also rallied on earnings. We'll talk about that on the show. Aside from that, we already saw chip stocks recover in Seoul yesterday. SK Hynix also jumped, now at a premium, these ADRs, to the Korean share. So we'll take a look at that as well on the show. But, Shery, the focus on the U.S. data and on Warsh as well.
Yeah, Fed Chairman Warsh, as you mentioned, doubling down on that commitment to tackle inflation. Speaking before House lawmakers, Warsh repeated a promise to tame price growth even after U.S. CPI fell in June for the first time in 6 years.
Get policy right, and I can assure you we will. The inflation surge of the last 5 years will be a thing of the past. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to ensure price stability.
For more, let's bring in our U.S. Treasury reporter Daniel Flatley in Washington. Bloomberg Life strategist Marc Cranfield also joining us from Singapore. But Dan, let me start with you because we want to break down the June CPI numbers at the same time, try to understand why Chairman Warsh didn't necessarily back off from his hawkish tone.
Yeah, it's a great question, and I think we got certainly the first substantive comments from Chair Warsh since he's been in that position. He was on Capitol Hill for several hours today, and we heard a clear message, which is that the inflation fight is not over. Of course, he didn't lock himself into any particular course of action here, and we know that everyone has been looking to see or some indication of whether there may be a rate hike in the future, and we didn't get any indication of that necessarily today, but we also heard from Chair Warsh that he is very much focused on that question of persistent inflation, and as you mentioned, we did get a little bit of a cooler print today, but he said, in his words, in Chair Warsh's words, that it's not mission accomplished. So we'll have to see where things go from here.
Yeah, Daniel, any indication at what Chairman Warsh is actually watching here in order to perhaps say that inflation has turned the corner?
Yeah, it's interesting. I mean, we have a very noisy environment, as you mentioned earlier. We do have the resumption of fighting in the region around Iran and the Strait of Hormuz. And one of the reasons that economists have cited for the cooler print today was energy costs coming off a little bit as a result of the ceasefire that we saw in recent weeks. Of course, that appears to be over. We don't know how long the fighting will continue. President Trump has indicated that he is still willing to talk to leaders in Iran. And certainly we know heading into the midterms, the Trump administration broadly wants to get the economy in a good place, and having elevated oil prices and fighting in the Middle East and all of these factors is not something that they want to see, certainly in a prolonged state of affairs. So I think that that's one of the things that that Chair Warsh and others are looking at is, is this cooling off a result of something that's a temporary situation, or is this something that we can sort of see as a downward trend going forward?
Yeah, especially given that we do have PPI coming up this week, which will sort of point us to a direction of PCE, right? When it comes to the Federal Reserve, then, what should we be watching out for in the next few days in order to sort of gauge where Chairman Warsh is headed at a time when he's also made it quite clear that he doesn't necessarily believe in telling markets too much?
Yeah, absolutely. I mean, it's a great point. He has spoken in recent days, and again today he reiterated this idea that the Fed will not be issuing as much forward guidance as it has in the past, that they will call quote-unquote balls and strikes in a way that he feels was not done in more recent times. We'll hear again from him tomorrow on Capitol Hill, and moving forward, we'll see sort of where things land. I think that he is sensitive to a certain extent, although he obviously defended the independence of the Federal Reserve today in congressional testimony. But President Trump is interested in lower interest rates. He's made no secret of that. And so there is some pressure from the White House that Chairman Warsh will have to contend with.
U.S. Treasury reporter Daniel Flatley, thank you. So, Marc, it seems like the markets reacted more to the U.S. CPI because Warsh was maybe, stuff had already been priced in. So what are we expecting for Asia and the Treasury's rebound? Is that sustainable?
Well, yields started to come back up again before the end of the business last night. I think traders are pretty skeptical about one CPI print. There seems to have been a big adjustment related to some domestic fuel changes, which account for quite a lot of the drop in the CPI data. So although Treasury yields came off at first, some of them were starting to go back up, particularly in the longer end of the curve. So actually the net result last night, there was quite a lot of curve steepening driven by lower two-year Treasury yields mostly. Because of that, you get a mechanical reaction in the way that Fed pricing goes. And so the July bets are really linked to the drop in the two-year yield. That's not surprising at all. That's typically what happens. If this week we get a piece of data which goes the other way, the bets will go back for July. It's almost a knee-jerk reaction. It doesn't really tell us very much at all. Traders are still thinking that there could be one hike by the end of the year. The people who are looking for sustained inflation and generally higher Treasury yields will probably be encouraged by the fact that Kevin Warsh said the job is not done yet. So clearly they'll be looking for more information. And other Fed people over the last few days have also said that they're concerned about the stickiness of inflation. So he has said before that he's hoping for a good family open discussion when they have their next meeting. It looks like it's exactly what he's going to get.
Does that mean the specter of more bond market volatility? I mean, if you look at the two-year yield, it moved 13 basis points at one point. I think that was the steepest move since August last year. Is this a sign of things to come?
The less information that you provide to markets, the more volatility you're going to get. I mean, as lots of people have done calculations, Bloomberg has written about it themselves, is that a lot of forward guidance over the last decade or so has helped to reduce volatility in the Treasury bond market. You take that away, you go back to the days of Alan Greenspan when he hardly gave anything away. In fact, Kevin Warsh did a very good impression of Alan Greenspan last night. If you go back to those kind of days, you are going to get more short-term volatility in the bond market. It's inevitable. So that appears to be where we're heading.
But at least for Asia and risk assets, the US CPI kind of clears something out of the way. But then you put that along with oil prices. I mean, net, where are we? Well,
oil prices are firmer. We haven't yet got to the kind of levels that will really scare people. If we get to $100 a barrel on Brent, we're still $10 or so away from that. If we get to that kind of level, yeah, people will be pretty shocked. They'll be very concerned. We haven't done that yet, although they've picked up from the recent low levels. The SOX index, Philadelphia SOX index, rose again last night. So people are beginning to shake off some of these concerns. Kospi futures had a very good night. So things are starting to get back to some kind of normalization. There's a lot of bluster and noise coming out about the Strait of Hormuz, but underneath it all, so far I think people are reading it as being not a major step up from what we've seen before. There isn't anything dramatically different. Business is going on. The tech sector previously was a bit of a shelter from some of the noise in the rest of the market. So people are looking back at what was our experience in March, April, that kind of period, and they're beginning to draw from that. The world went on, people continued to make money, and generally the big tech companies, particularly the AI stories, were largely immune from what was going on in the rest of the world.
So we might see a bit of that continuation today. Marc, thank you so much. Bloomberg MLife strategist Marc Cranfield. Now we'll talk more about that so-called bluster around the Strait. President Trump backing away from plans for tolls in the Strait of Hormuz, even as the U.S. resumes its naval blockade. The latest Middle East developments coming up after the break. This is Bloomberg.
You have Saudi Arabia, UAE, Qatar, Bahrain, and Kuwait, primarily, and then others. I spoke to all of them, and they would love to invest more money in the United States at record amounts, and that would be very acceptable. And this way, there's no fee.
President Trump discussing his decision to drop plans for fees on shipments through the Strait of Hormuz, saying Gulf states have promised to make up the revenue with direct investments. Meanwhile, U.S. forces have reimposed a naval blockade and launched a new wave of strikes on Iran. Trump is also threatening further attacks in coming days unless Tehran comes to the negotiating table.
Do you anticipate that the strikes we're seen this week against Iran will expand? Are you considering hitting energy targets or other locations inside of Iran?
I'll save the energy targets for last, but ultimately we'll hit energy targets, yeah. But we're going to hit them very hard tonight. We're going to hit them very hard tomorrow night. We're going to hit them very hard the night after. And then next week it gets really bad for them because next week comes the power plants. Next week comes the bridges.
Let's bring in Bloomberg Politics editor Romy Varghese. Romy, the president backing down on that 20% fee through the Strait of Hormuz really quickly. What happened?
Well, when Trump first proposed his 20% fee idea yesterday, there were no details. There were no indications that he spoke to allies about it. And so today, yes, Taco Tuesday, he said there would be no fee after all. And, this back and forth really shows us two things, right? Number one, this is the latest example of Trump. Whenever he gets frustrated, he makes a snap decision, and that either gets implemented in an ad hoc fashion or gets, reversed in some way. And two, the fact that Trump backtracked shows what a difficult position the United States really is in, because Iran has shown through this conflict that it has effectively controlled the Strait of Hormuz, that it's controlling, this critical waterway where about a fifth of the world's oil supplies goes through. And they're not going to very quickly give up this leverage.
In the meantime, we continue to see casualties, even deaths, when it comes to these vessels that are transiting the Strait of Hormuz. How difficult is the situation there?
We are seeing very low traffic. Before the United States began its blockade today, much of the traffic were just Iran-linked ships. We saw 2 UAE tankers under attack. Traffic is nowhere near where it was before the conflict started in February, and not close to the levels after the ceasefire when we did see some traffic increase. So yes, we are in a difficult position because Iran has made it clear that no matter what, it wants to see whatever kind of interim peace deal comes out of this. They want to, have some sort of control over the strait with some fees or some revenue sharing with Oman. It's not going to give up this leverage that quickly.
Romy, thank you so much. Bloomberg Politics editor Romy Varghese with the latest on the conflict. Now, former U.S. ambassador to China Nicholas Burns is warning of prolonged instability in the Strait of Hormuz, seeing little prospect of a near-term resolution to the war with Iran. He told us more about the risks of what he describes as a drawn-out cat-and-mouse conflict.
I think it's crystal clear right now that this ceasefire agreement has fallen apart, that it's not being honored by the government of Iran, that there's substantial differences between the United States and Iran on what that ceasefire agreement said. The Iranians believe, I think erroneously, that they get to run the Gulf, the Strait of Hormuz. They get to be the toll keeper, exact fees, establish a fee structure. There's not a government in the world that agrees with that. And I don't see any way that President Trump can ever agree to that. That would mean Iran emerges from this long war of 4.5 months stronger in that respect than when the war began. It would be injurious to the global economy, to insurance companies, to shippers, to people who, the companies that depend on the free flow of commercial traffic. So I think that the president cannot, and I believe will not give in, our president, on that issue. I don't think the Iranians are going to give in. So where does that leave us? I think a cat and mouse, probably next couple of weeks or months leading into the autumn, where there's a back and forth. They agree to a ceasefire. The ceasefire is honored, then not honored. They go back to exchange of fire. And I think that's where we are, because these are hard-bitten, highly ideological leaders in Iran. They think they can play us for time, and so they're testing us. It's very important that President Trump stands up to them in that respect and not give in on issues like Iranians becoming the Tony Soprano of the Strait of Hormuz, exacting tribute from other countries.
If Steve Witkoff were to give you a call, or Jared Kushner, what counsel would you give them about how to move forward here? It sounds like what you're prescribing or anticipating is a long period where things are effectively stuck.
Well, certainly I wish President Trump and his team well. We want them to succeed on behalf of the United States. I do think the original agreement, was not well done. A lot of loopholes. The Iranians are trying to race through the loopholes. So on the one hand, you may need to go back and renegotiate this, and that could take a substantial amount of time. I don't think it's reasonable to expect that there's going to be a perfect deal, perfectly arrived at and implemented anytime soon. I think we're going to be in a period of instability in terms of shipping through the Strait, a low-intensity conflict between the United States and Iran, major disagreement on the future of the Strait. I see this going into the autumn.
Any of this a surprise to you, based on how it's all unfolded?
It's not. I must say I was the first Iran nuclear negotiator for President George W. Bush, Condi Rice, 20 years ago, a long time ago. But you took the measure of them then. They haven't changed.
Former U.S. Ambassador to China Nicholas Burns speaking with Bloomberg's David Gura. We have more ahead on the Asia trade. This is Bloomberg.
Looking forward, we know that things rarely move in a straight line. While we continue to see a largely resilient economic backdrop in the U.S., risks can emerge quickly and drive periods of disruption and volatility across markets. A keen focus on risk management remains paramount as we support clients across a range of market conditions. But it's also clear that we are seeing broad-based momentum across the franchise and a very strong environment for client activity.
I can't tell you that it's impossible that we will exceed the 11%. We're just not going to box ourselves into that, given that we see opportunity to take actions on the offense, which are accretive to shareholders and support our path to our medium-term targets.
I just think we're in a very healthy, active, exuberant market with very high prices and very high volumes, and we benefit from that. We just don't know how long it will continue. Could it get a lot better than this? It can get better, but how much better, I don't know.
The chiefs of some of the biggest U.S. banks on record second quarter results from their stock trading divisions. For more, let's bring in Bloomberg Intelligence U.S. banking and financial senior analyst Herman Chan. Herman, how sustainable is all this, these strong trading results for the back half of the year?
Well, first, I wish President Trump well. We want them to succeed on behalf of the United States. I don't think we are in a very healthy, active, exuberant market with very high prices and very high volumes, and we benefit from that. We just don't know how long it will continue. Could it get a lot better than this? It can get better, but Yeah, that's right. That was the key question after we saw the really robust trading results in the second quarter. And that was a key question that the analyst community really probed in on. That being said, there was a lot of outperformance in the second quarter related to events like the SpaceX IPO, AI-driven trading. Some of that could be unsustainable, but there is still a fairly constructive trading backdrop that should sustain results, particularly in equity trading for the back half of the year.
Yeah, we saw Citi lagging a little bit when it came to its stock reaction as well. What drove the relative underperformance when it came to their earnings beat?
Yeah, that's right. Citi also reported really strong results. Return on tangible common equity, 13%. That matched a strong result in the first quarter, driven by trading, investment banking, strong services revenue. What really drove the underperformance was Jane's commentary that was just broadcast on the show, where she mentioned potentially higher expenses in the back half of the year, including investments to really sustain the higher return levels that they expect over the short to medium term. That could reduce the profitability metrics in the back half of the year to drive overall returns to the 10 to 11% range relative to the first half of 13%.
Herman, we're also seeing how traders are still expecting a hike by the end of the year, even though bets for July have dropped off following the US CPI print. How is all this affecting expectations for margin, net interest income?
Yeah, that's right. So the banks are now generally expecting a higher for longer interest rate backdrop. That's supporting net interest income and net interest margin expectations for the banks. JP Morgan and Bank of America both lifted net interest income expectations for the full year. Some of that's driven by the higher for longer backdrop. The other factor that's driving that is balance sheet growth, particularly in deposits and in lending. So in the U.S., there's really strong demand activity, particularly in commercial lending, and deposits have really held in there, and particularly for the money center banks like JP Morgan and B of A, where they're seeing strong deposit activity from their wholesale clients and their consumer franchises.
Bloomberg Intelligence U.S. banking and financial senior analyst Herman Chan there. And of course, another story that we're following right now is Warren Buffett pledging to completely dispose of his roughly $140 billion stake in Berkshire Hathaway over the next 8 years. He's announced a new round of donations to charities tied to his family, but paused donations for the Gates Foundation for the first time in nearly 2 decades. That comes after the release of documents reigniting scrutiny of Bill Gates' ties to the late sex offender Jeffrey Epstein. And we had some breaking news earlier today when it came to the jobless rate in South Korea falling to 2.7%, really propped up by those government support jobs. But at the same time, we did see, of course, giving some more impetus to the Bank of Korea's tightening policy that we're expecting when that decision comes on Thursday. This is Bloomberg.
This is what futures are pointing to in a week where, when we came in on Monday, there were a number of overhangs for markets. You think about how the US-Iran conflict had resurfaced to the extent which it propped up oil prices and caused massive repricing in bonds. And now it seems like some of that overhang has been removed. A bit of that risk coming on from the US CPI, or coming off from what we saw in the inflation data, softer than expected. So that massive repricing came on the front end of treasuries. We saw almost a 13 basis point move lower in the 2-year yield policy sensitive part of the curve. Futures on the 10-year also pointing to maybe a bit further gains. So as our colleague Marc Cranfield had been highlighting earlier, there is a bit of skepticism out there still, especially when you consider these tensions still between the US and Iran. Trump is now talking about threatening about these strikes on civilian infrastructure in Iran next week. We've been talking about as well, maybe this is part of the strategy to escalate, then de-escalate to get what he wants as far as the conflict is concerned. And then, of course, when it comes to trade overall, where the memory makers are, when you look at how overnight in the US, we saw a further gain in the SK Hynix ADRs, tracking also that rally we saw late in the session yesterday in South Korea, Shery.
Yeah, and as you mentioned, really, it was that repricing when it came to the markets right after the cooler than expected U.S. CPI data from June. And that was surprising because despite the fact that we got a cooler number out of the June inflation data, we didn't necessarily see Fed Chairman Kevin Warsh at his congressional testimony change the more hawkish tone that he's really adopted lately. Let's discuss what's happening in the broader U.S. economy. Joining us now is Chris Hodge, Chief U.S. Economist at Natixis. Chris, really good to have you with us. If the burden of proof for Kevin Warsh was just lower inflation in order to perhaps avoid a rate hike, are we starting to see that with the June CPI numbers?
Absolutely. This is the first brick in the disinflationary wall, but you're going to have a few of these. And as you mentioned, I think quite rightly, that the burden of proof is on disinflation from here on out. Now, we are cautiously optimistic that this is the first of several prints that we're going to see. It's hard for me to see where the inflationary impulse is going to come from.
Where did it come from in June, and could that remain for the rest of the year?
Well, I mean, it was noticeably absent. If you look across component, the negative reading for energy in the headline, that was to be expected given the move in oil prices. But if you look at core goods, that was negative for the second consecutive month. That indicates that tariff pass-through is almost completely over. If you look at housing prices, this is now more aligning with real-time data that we get, and with low household formation in the U.S. and affordability concerns, it's hard to see a demand impulse coming from the housing sector. And service prices are largely a function of wages, and wage growth has been pretty tepid overall, about 3.5%. And when you combine with strong productivity, that puts wage growth just around target inflation. So what really struck me was the breadth of disinflationary pressures that we saw from this print.
Fed Chairman Warsh still thinks that there are internal dynamics here at play when it comes to price pressures, aside from the external shocks like the Middle East. What could he be looking at, and what does he need to see in the sequence of data in order to change his mind when it comes to the Fed path?
Yeah, I think, if you're looking at price pressures, you're looking at residual effects from the AI CapEx build out. So semiconductors, flash drives, memory drives. This is certainly a concern for the Fed. But I think, with the burden of proof on multiple consecutive prints being lower, that's a function of not being at target inflation in over 5 years. And, I was in attendance when Governor Waller spoke yesterday, and he essentially said that the Fed's out of excuses for inflation, that whether it comes from exogenous factors or endogenous factors, it's time for the price level to come back down to where it was before, to the Fed's 2% target. So again, the Fed's going to still have to see multiple prints before it changes its tune from hawkish to neutral.
And at what point can we expect potentially higher oil prices, especially given that we have no resolution to the U.S.-Iran war to reverse its inflationary trend and actually contribute again to price boost?
Yeah, that is the major question right now, right? So even the oil price increases that we've seen in the past 48 hours or so, it hasn't gone back up to levels that we've seen in March and April, but that risk is still out there. So I do think that if we start seeing if we start seeing oil prices drift back up to $85, $90, $100 a barrel, that is going to make the Fed pause. Now I will say that the pass through from higher energy prices to core inflation, that was fairly muted as well. So I think over the longer term, it's not going to be much of an issue, but it will cause the Fed to pause enough to not shift to that neutral or dovish stance.
What are you expecting to see in PPI numbers this week as well? Because we do have the PCE pass-through, right? So when it comes to getting that Fed's preferred inflation gauge data, what are the components that you'll be watching?
Yeah, airfares, portfolio management, some components of medical. These are the ones that would pass through to core PCE. But I'm fairly optimistic that we're going to get a soft PPI number as well. Even if we got one that's in line with the consensus or even a little bit above, we're still looking at a PCE that's going to come down from where it was in the prior month and be another brick in that disinflationary wall that we are expecting.
When it comes to artificial intelligence and the technological advances that we're seeing right now, do they have any inflationary effects right now without just looking at the long term that could add to the overheating trend of an economy?
Yeah, that is the big paradox that is facing the Fed right now. And Chair Warsh was very vocal about the fact that productivity gains in the future will allow prices to eventually come down. And that was, when he was still a candidate to be the Fed chair, that was one of the things that he harped on the most. The problem is in the here and now, it is putting upward pressure on certain components of inflation. But I don't think it's enough to trump the other components where we are seeing disinflation overall.
We're seeing also thousands of layoffs, both in the tech sector and the financial sector, being attributed to changes because of artificial intelligence. Do you take that into the net account as well?
I do. I do think that's more of a micro story than it is a macro story at this point. I do not think that the labor data that we've received over the past 4 months is necessarily indicative of the health of the market. People are still very concerned about finding a new job. The amount of time it takes for somebody to find a new job has continuously gone up. So I don't think labor demand is very strong. And I think AI is certainly part of that story, but I think it's part of that story in specific sectors that hasn't necessarily bled through to the rest of the economy.
If from now on we're not necessarily going to see potentially Fed Chairman Kevin Warsh being a little bit not as forward-looking when it comes to forward guidance and not being as communicative, where are you going to try to get the hints of where the Fed goes from here?
Wherever I can get it, and when there is a void for communication, that's going to get filled. It'll get filled by the regional presidents. It'll get filled by some of the other governors. So I do think it would be helpful for Chair Warsh, not necessarily to lay out forward guidance, because we're not at a time where the Fed can offer any forward guidance. We don't know what the trajectory of inflation is going to be for sure. So forward guidance is not an appropriate tool right now. I do think what is appropriate is for the Fed to lay out what its proper reaction function is. That what are the things that it is looking for to assess the health of the labor market and the trajectory for inflation. That will be helpful for markets, and I think that will be helpful for the Fed as well.
Chris Hodge, good to have you with us, Chief U.S. Economist at Natixis. We have more ahead on the Asia trade. This is Bloomberg.
IBM shares fell the most since at least January 1968, wiping out $69 billion of market cap after preliminary second quarter sales fell short of expectations. The company blames the miss on customers shifting spending amid AI fuel shortages. Let's bring in tech reporter Brody Ford for us now. So, Brody, the firm blamed this on the customer spending on chips and servers instead. Walk us through what it's saying, and are there any improvements that IBM itself can make?
The big background here is that hardware components for AI have gotten very expensive, right? Think about the memory chips everyone's always talking about. A slew of other components have become more competitive to get, and it's driving up prices for them. What IBM says happened is that customers tried to accelerate their purchases of these memory chips, and that caused them to divert spending from IBM's hardware solutions. Now, what the anxiety this really hit is the question of all the money getting spent on AI, where is that coming from? And the fear has been that it comes at the expense of the traditional leaders, right? That it's not additive, but that it's a zero-sum spending pool. And so IBM's results today seem to justify these anxieties.
And what implications does this hold for other companies in potentially the same moat that could see the impact like IBM has felt it now?
The big debate I'm seeing out there is whether this is a hardware story, right? Is this that customers of IBM mainframes are saying, let's actually update our infrastructure and go to something more modern? Or is this a broader story about all tech spending, all enterprise IT spending is getting deprioritized because customers are now buying more AI hardware? Right. And so we saw a lot of software names go down today because the fear is that, well, maybe you're not going to buy as much, Salesforce licenses or Microsoft Office seats if you're going out and trying to procure a bunch of memory chips. That's what the anxiety is. It's unclear, though, to what extent this is an IBM story or is this a sector-wide story?
Our tech reporter Brody Ford there joining us with the latest on IBM. Of course, we'll be watching their tech peers here in the Asian session as well, especially when it comes to the Kospi, which gained ground in the previous session. We had seen a little bit of strength for the Korean won as well. This, of course, as we're getting those expectations of more inflows to come into the South Korean economy from SK Hynix ADRs. We have seen that volatility on SK Hynix for the last few days. We're talking about a jump of 27% on ADRs on Tuesday, just falling 9% on Monday. But the ADR premiums from SK Hynix ADRs to what we're seeing in South Korea Seoul shares has now surpassed 50%. So that's an enormous really gap from what we saw before at around 3%. So let's discuss what's happening in the Asian equity space, especially what we can expect in today's trading session. Asian equities reporter Winnie Su joins us now for a preview of the market open in South Korea. Winnie, so I was talking about volatility not only on SK Hynix, Samsung, but also just the broader Kospi space.
Yeah, exactly, Shery. So today, as you just mentioned, we're seeing slightly a bit of an upside coming through because of the overall macro environment looking quite good, and also that ADR jump. Well, I think lots of traders, in fact, right now scratching their head why the ADRs have jumped so much. We're talking about 27% and also premium widening to 50%. So what we've been hearing a couple of things. One is that potentially because how options have started trading on Tuesday, and we're seeing lots of call options coming through, which means that the underlying, the dealers will have to buy more of these underlying ADRs to hedge their positions, and that is kind of driving lots of volatility and lots of buying there. But also, we are also hearing some target price upgrades from the likes of Barclays, for example, citing that they are expecting that valuation gap to narrow with Micron and that the memory shortage to continue further. Now, another potential factor is just how overall investors' appetite for the ADRs are very strong, especially in the U.S. with the high liquidity and the flexibility. Now, they are seeing a bit more buying opportunities after how these ADRs have slumped 9% the day before, and that some hedge funds are also liking these pair trades to long, for example, Hynix, and to short Micron. So we are seeing those playing out as the different factors. So into today's session, we will likely going to see if that overall sentiment likely going to support the SK Hynix further, or if we're still going to see that dynamic between retail investors and foreign investors.
Winnie, where does this leave the rest of the market, not part of the memory trade, where there were hopes of a bit of rotation coming for value as well?
Yeah, so for now, there is a lot of talks, of course, when it comes to the rotation. And we're still seeing in the short term that investors are rotating out of the more crowded trades when it comes to Samsung and SK Hynix, which have really rallied a lot, including Japan's Kioxia as well. And we are seeing more appetite turning towards the underperformers, the likes of Chinese internet names, India's banks, and also some of these Southeast Asian countries as well. So for now, they are actually looking for more value to come. But interestingly, when we just go back to what's going on in the South Korea market, we talked about how investors are more interested in the ADR listing in SK Hynix. But just yesterday, we've also heard that there is potentially some early discussion with between Samsung and the banks to potentially also consider a listing of their ADRs. Now, it is still at the very early stage, and they are considering that also because of the successful ADR listing by SK Hynix. But this morning, we did hear that the company said that they are actually not reviewing that possibility just yet. But it really goes to show how overall the appetite for the memory space and also that AI demand still remain quite intact.
Bloomberg's Asia Equities reporter Winnie Su there. Let's actually stay on these tech stories because Chinese AI startup DeepSeek is now set to be laying the groundwork for an IPO as well, with a filing possible as soon as this year. Sources say the company is working with accounting firms on its financials and is targeting a market debut around late 2026 or early 2027. We're told DeepSeek is also seeking fresh private funding ahead of the offering at a valuation of at least $71 billion. Chinese memory chipmaker CXMT is set for one of the biggest listings on Shanghai stock market, seeking to raise as much as $9.8 billion. The world's fourth largest DRAM producer has priced the offering at 866 yuan a share. The listing comes as Beijing pushes to build a domestic AI chip supply chain and challenge industry leader Samsung and SK Hynix. A Bloomberg scoop has lifted the curtain on OpenAI's much-anticipated move into consumer devices. Sources say it's planning a mobile screen-free smart speaker designed to be a new type of home computer for the AI era. It will help control smart home appliances, play media, answer questions, and tap into the range of capabilities offered by ChatGPT. You can get more of the biggest stories in tech on the Bloomberg Video Hub. You can also check out past episodes of Bloomberg Tech Asia and the other shows on Bloomberg.com/videos. This is Bloomberg. We have core machine orders for the month of June here in Japan, coming in at a contraction of 12.4%. When it comes to the latest in Japan, we're talking about more than 12% contraction for the month of May. This is actually a bigger contraction than the 4% that we had seen economists expecting. Also, it's a contraction from gains in the previous month. When it comes to the year-on-year numbers, a contraction of 1.9%, which is also a contraction after expansion in the previous month and expectations that it would actually grow in the double digits. So, Avril, we are seeing, of course, a little bit more of that sentiment dampening when it comes to the corporate sector.
Yeah, which is interesting when you put this together with what IBM showed us overnight, right? In terms of its market cap really being erased and how it saw customers diverting spending towards chips and servers. How does that sap some of the spending that comes typically for IBM's hardware? So we're also watching in the session today some of these IT-related stocks, software stocks as well. How does that also offset some of the recovery we might be seeing for the memory trade following on from yesterday already, what we saw on the rebound in South Korea, which extended into the SK Hynix ADRs? Look at that massive premium that we saw overnight and put that together, of course, with this macro backdrop for the US CPI coming in softer than expected. That really goes to show maybe this is a sign of the bond market volatility that could come, because you look at the front end and how that 2-year move, the 13 basis points down, I think that was the largest, steepest move since the month of August last year, at a time where the likes of Kevin Warsh telling us, don't expect that forward guidance. On the Hill, he doubled down on all that talk on fighting inflation. Not mission accomplished yet, he said. Take a look at how that is affecting the front end in developed market debt markets, right? So you're looking at the 3-year yield nudging lower in Australia, in New Zealand as well. So maybe a bit of stability that's coming off the back of this US CPI print that is showing that readjustment in market, Shery.
Which we saw in the U.S. dollar as well because of those numbers, right? The dollar falling. It did pare losses a little bit after the chairman, Warsh, reiterated the Fed's price stability vow. But we'll continue to watch the other side of that trade because the Japanese yen still holding at that 40-year low against the U.S. dollar, while the offshore yuan also holding steady at that 677 level. But the euro also has been hammered by the strength of the U.S. dollar in recent weeks. We're watching emerging market currencies as well, which took a plunge after we saw that more hawkish tone coming from the Fed chairman. The market opens in Sydney and Seoul and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens with oil prices continuing to edge higher. Of course, Avril, we have the U.S.-Iran conflict ongoing, at least when it comes to the inflation front. Some relief coming from cooler U.S. CPI.
Which is also interesting given Warsh's testimony on the Hill. He sounded really determined about fighting inflation, how they're not mission accomplished yet. So maybe that reflected in the skepticism, the paring back of that rebound that we saw in treasuries to some extent, Shery.
Yeah, also the U.S. dollar and, of course, that pressure on all Asian currencies at the moment. Not surprising, given, of course, that we have seen the Japanese yen, for example, already trading at that 40-year low against the greenback. We have seen that upside a little bit more broadly with Nikkei stocks rising, also JGBs rising in the previous session, because we're now back again focused on the great repatriation trade here in Japan. Finance Minister Katayama coming out and talking about potentially adding JGBs into individual investment accounts that are tax-free, or even being able to adjust those allocations from the government pension fund. So there's a lot of speculation about what happens if all of those flows come back to the Japanese markets. In the meantime, though, we are seeing the Nikkei gaining again today, with the topics of 0.7% and JGBs holding at that 267 level. We had a strong, solid auction coming from the 20-year JGB auction. We do have more JGB auctions to watch out for next week. But take a look at how South Korea is coming online, because we continue to watch the tech trade, the AI trade. A lot of volatility in this market. And of course, you can see a little bit of the divergence with the Kospi and the Korean won as well, because we're seeing a little bit more strength on the Korean won. We had seen it past that 1500 level, as we have now seen that speculation in this market as well, that we are going to see those flows from the SK Hynix ADRs that potentially can be invested into the South Korean economy. But SK Hynix, really, when it comes to those ADRs, we're now seeing the premium over Seoul shares topping 50%, when just last week, Avril, was at around 3%.
Yeah, when it comes to premium, talk about the geopolitical risk premium as well, right? Given these tensions between U.S. and Iran resurfacing, we're also since hearing that the Interior Ministry of Bahrain has said that the siren has been sounded. It's telling citizens and residents to remain calm and also to head to the nearest safe place. Now, as we watch the conflict and the impact that it's had on oil prices, take a look at where Brent is in the early goings of the Asia session, sitting above the 85 handle. Thus, that cap some of what we saw in terms of the reaction from treasuries following on from the U.S. CPI print on a day where, I guess, investors also weighing out these comments from Kevin Warsh. Let's bring in Marc Franklin, head of Asia multi-asset at Manulife Investment Management. So, Marc, there's a lot going on. What's top of mind for you?
I think there is a lot going on, and I think that the outlook is somewhat complex. One of the things that we're trying to grapple with is the extent to which we're going to see a renewed hardening of inflation expectations, again, as a result of the resumption of the conflict in the Middle East. If you look at the inflation data yesterday, it wasn't just about oil prices. There were definitely some signs of disinflation under the hood, and that's likely to persist. But of course, from a headline point of view, we're likely to see ongoing volatility of inflation, which makes it quite difficult to establish a trend in terms of fixed income trading. And then with respect to equities, we've seen recently rotational forces within markets, but we're approaching earnings season now, and you're likely to see the market focus mostly on those businesses and those sectors that are continuing to demonstrate above market growth potential.
Does that mean some of the value trades could benefit in the back half, especially the financial-related stocks?
Well, we've seen a bit of a rotation towards defensives and value cyclicals in the last couple of weeks as the steam was let out of the tech sector to some extent. But then you've actually started to see some profit-taking again in some of these moves. You look at healthcare in the last few days, it's starting to cool off a bit. So you might actually see a bit of a reversion back towards the year-to-date winners, particularly if they're catalysed by above expectations in the earnings season. But the bar is quite high.
So maybe the momentum, and maybe for memory, that still can be sustained. There's a chance that they regain their vigor that we saw in the first half. How intact do the fundamentals look to you?
The fundamentals look very strong, but markets tend to price in ahead of inflection points in cycle. And what you're seeing is definitely a strong cooling off, particularly in the memory names. There was a lot of speculative froth that built up, a lot of retail investors chasing the moves. That's cooling off a little bit, some margin calls kicking in there. The earnings outlook still looks very robust. Indeed, many of these companies are highlighting that the supply crunch will extend well into 2028. But at some point, the market will attempt to call the peak in the cycle, and in terms of that delta, the pace of growth. But for the time being, we think that's not here just yet. But that doesn't mean you're not going to see any more volatility in equity market performance, because indeed a lot of run-up, a lot of froth got built in.
That volatility also is drawing scrutiny, at least for the likes of South Korea. How much of that are you accounting as a risk for that market?
I think that the scrutiny has come after the horse has bolted, unfortunately, because it was pretty evident that there was a very aggressive build-up in margin financing by retail investors. And it's only when markets started to come down by high single-digit moves on individual days was there somewhat more of an investigative approach. I think the reality is these types of things need to be addressed well ahead of time. And with the event of single stock ETFs as well, that's another sign of exuberance. But to call it irrational exuberance, I think, is a bit of a hard call, because again, the fundamentals remain very strong.
And a sign of the times is what we're seeing in the SK Hynix Seoul shares today, jumping as much as 11%. This is following on from the ADR rally. There was that premium that came back for the ADRs versus what we saw in the Seoul shares. What is your sense of, I mean, when you look at the SK Hynix, the memory makers maybe repatriating some of their funds back to South Korea, does that give you a sense of how the Korean won also could benefit, especially if we see the dollar slipping in such a manner?
Well, there's definitely a benefit in having a diversified currency exposure on the balance sheet for these companies. Obviously, a lot of their revenues are denominated in US dollars anyway, so they're obviously repatriating those if they're generated onshore. RAM prices are priced in US dollars, so it's not a given that they will be automatically repatriating those cash balances back into Korean won, unless there is pressure from the government to do so, because of course, corporate earnings is a big driver of foreign currency flows, and up until recently, the Korean won has seen quite a pervasive degree of weakness, which has fed through into domestic inflation. So you might see a bit of political pressure to repatriate, but from a purely corporate incentivization perspective, there are benefits to retaining some of your cash balances in dollars, particularly if a lot of your cost base is in Korean won.
For South Korea, what was interesting amid the rally was how foreigners were sitting out. And then at some points last week, it looks like the selling among foreigners eased off a little bit. How are foreign investors viewing South Korea now? What are you advising?
Yeah, I mean, the observation was that many foreign investors that were latching onto this theme relatively early were selling into the strength. So it wasn't to say that they were sitting it out, but what they were doing was, as the position sizes in their portfolios grew very aggressively because of relative outperformance, it was more about managing concentration risk or managing active risk against benchmarks. Now, with respect to foreign investor appetite towards Korea, I think there's a recognition that volatility being heightened is probably here to stay for a while. But the issue is there's an absence of alternative opportunities within Asia beyond the markets such as Korea and Taiwan. If you look at Hong Kong, China and India, they've lagged significantly, but there's perhaps a lack of a very powerful discernible catalyst. So in the absence of an alternative home for that capital, you might see foreign investors step back in if the pullback continues more.
What about Japan?
Yeah, I mean, it's had a great run in terms of both relative and absolute performance. Valuation multiples are by no means cheap. They're probably at the upper end of historical trading ranges, but for some good reason. Obviously, you've got a fiscal backdrop, which is generally very conducive towards reflationary policy and good for the corporate earnings backdrop. The currency is very competitive, so that really helps the exporters. I think in addition to that as well, you've got bottom-up catalysts via corporate governance reforms, improving shareholder return policies. But again, some of that is to some extent baked in the price. As long as Japanese corporate earnings revisions are faring well against broader global equity markets, there will be a bid from foreign investors. But I would say that the low-hanging fruit in terms of that valuation multiple re-rating has by and large played out, and now it's all about fundamentals driving future returns.
What about the comments we've kind of heard from Katayama in the past week, right? This idea that maybe they'll focus more with these Japanese assets. Maybe that means repatriation of funds as well. I mean, does that move the needle then?
Well, they've attempted to obviously directly intervene in currency markets a few times in the last few months, and whilst they've had an initial impact, the trends have subsequently re-established themselves, and the yen has resumed its weakening path, particularly against the dollar. So what they're looking to do is attempt some more creative approaches to try to stabilise the currency, because they recognise that it has an impact in terms of real wage growth, inflationary pressures, perception around purchasing power for the consumer. So one of the things you're likely to see is a reappraisal over the extent to which the policymakers need to support domestic assets. It's more likely to be focused on JGBs because there's a double benefit, helps to stabilise the currency, but also helps to stabilise perceptions around the bond market. So it's not necessarily the case that domestic equities will be the prime beneficiary. But of course, what they're needing to fight as well is the sense that the government is hell-bent on a fiscal stimulus package and ongoing fiscal support for the economy, and that is something that foreign investors also have to weigh up in terms of fiscal sustainability.
Are you expecting stimulus from Chinese policymakers? I mean, we were expecting the China GDP today to maybe point to further softness. What is that going to mean for assets, which at some point seem to be trading away from the macro backdrop?
Yeah, I mean, if you are a domestic investor in the mainland China and you're seeing a lack of policy stimulus catalyst, and you don't have too many means of taking your capital into overseas investments, you're probably more likely to lean towards bonds. And that's why I think that bond yields have continued to be relatively compressed and the currencies perform quite well. As we approach 2027, which is a symbolic year for the CCP, you're likely to see a refocus on trying to drive economic momentum momentum cyclically, but that may well be back-ended this year into the early part of next year. There's still a certain degree of reticence to stimulate the economy in a broad-based way, because effectively that devolves economic decision-making power to the private sector, to households, where there's still a force towards centralisation and more state-driven policy initiatives economically.
Marc, we have to leave it there for today, but great to have you in the studio talking us through everything that's going on. Marc Franklin, Head of Multi-Asset Solutions for Asia at Manulife Investment Management. We have more ahead on the Asia trade. This is Bloomberg.
You have Saudi Arabia, UAE, Qatar, Bahrain, and Kuwait, primarily, and then others. I spoke to all of them, and they would love to invest more money in the United States at record amounts, and that would be very acceptable. And this way, there's no fee.
President Trump discussing his decision to drop plans for fees on shipments through the Strait of Hormuz, saying Gulf states have promised to make up the revenue with direct investments. Meanwhile, U.S. forces have reimposed a naval blockade and launched a new wave of strikes on Iran. Trump is also threatening further attacks in coming days unless Tehran comes to the negotiating table.
Do you anticipate that the strikes we're seen this week against Iran will expand? Are you considering hitting energy targets or other locations inside of Iran?
I'll save the energy targets for last, but ultimately we'll hit energy targets, yeah. But we're going to hit them very hard tonight. We're going to hit them very hard tomorrow night. We're going to hit them very hard the night after. And then next week it gets really bad for them, because next week comes the power plants. Next week comes the bridges.
Let's bring in our East Asia government editor, John Herskovitz. John, I mean, the dropping of the 20% fee, that was fast. No wonder the taco trade is back in the markets. What exactly happened?
Yeah, I mean, Trump said that he heard from representatives of Gulf states, and they agreed to this investment as something else for raising money. One of the Gulf states is questioning whether this has actually happened. But the thing is, I mean, the idea of imposing fees, it ran counter to the U.S. policy of ensuring freedom of navigation. It ran counter to international law. It was America's allies and enemies alike were opposed to this. It meant more cost for oil. There was just a lot of pushback from this, and we saw the energy markets. Brent jumped incredibly after this went into effect.
Topping $85 a barrel right now. The risks, given that we really don't know where we're at in this negotiation.
Yeah, the risks have just mounted. We've seen the economic pressure escalate. So the naval blockade is back in place. We had the removal of the waivers on Iranian oil a week or so ago. And we're probably going to see an escalation on the military front from the U.S. and probably Iran as well. We don't know how that's going to play out, but the risks are increasing. The risks to shipping are going up. The risk to energy supplies are going up, and we just don't see a way out of this.
Yes, we continue to see those casualties and even deaths in the Strait of Hormuz. What do we know about the potential political ramifications for President Trump? I mean, coming into this conversation, I called it the taco trade, which is what markets are doing at this point.
Yeah, I mean, for Trump, the risks just keep going up. We have the November midterm election. His Republican Party is facing a serious challenge. And the way things are going now, gas prices are set to be elevated at that time. The war is set to be going on at that time. He actually may have to go back to Congress to see about the War Powers Act. He's trying to reset the clock for that. So the political ramifications at home are going up, and then there are the international ramifications. Allies weren't on board with this, and these abrupt changes from the 20% fee to dropping it. How do you keep allies on board when they don't know what the policy is going to be day to day?
John, thank you so much. Bloomberg East Asia government editor John Herskovitz. Now, for more on the status of the Strait of Hormuz, let's bring in Bloomberg oil reporter Nicholas Lua. So, Nick, we are seeing, I mean, just looking at the Brent curve, right, all the way out until the January contract next year is above the 80 handle. What is the risk for markets?
I think it's very clear that people are worried that this crisis is going to be prolonged. Like maybe 2 weeks ago, before this latest escalation, it seemed like we were finally working our way through, right? The ceasefire was going, people were talking, negotiations were happening, and now all of that's been blown off the table quite literally by the strikes. We've seen 2 tankers, of course, been hit, like ADNOC tankers owned by the UAE, hit in by Iran, and as our latest reporting has shown, these tankers are actually were traveling dark through the strait, right? And so what this means is that, in a way, like the dark route, like companies like ADNOC, like Kuwait, moving tankers through dark, like that was the main way by which crude was getting out to global markets. So if Iran is able to signal that those tankers, like we know what you're doing and we're able to hit you if we wanted to, I think that's going to add a lot of caution, right? So ship owners, captains, people would think twice before continuing to move the energy the world is starved of through the strait.
But we also get a sense of how Asian buyers are getting supply from the US, right? So how much of that is helping to offset the supply crunch?
That's a really good question, Avril. And I think what's interesting about that is that those discussions are actually more in the conversation stage right now. So yesterday, after the whole discussion about that 20% fee on Hormuz transits that Trump was talking about, there were conversations that were opened about whether, if this makes crude coming out of the Middle East too pricey, what other alternatives do we have to look at, right? I think one thing our reporting showed was that while these conversations are still very initial, it's clear that the bids and offers are very wide. So no one's really reached the point where we're like, okay, we're raring to buy US crude at the moment. But again, of course, we've seen US crude serve as the supply of last resort when the Middle East flows were completely cut. And so I don't think that's off the table, right? I could see many term buyers in the US potentially being the big winner if, let's say, things go south again in the strait.
And I suppose it doesn't really surprise us that just as quickly as that 20% fee was floated, it was backed off again.
You're totally right. I think it became clear yesterday that a lot of people found this measure, like, again, out of nowhere. It was very clear that it was impractical, hard to implement. And I think that's what a lot of the experts were talking about as well, right? So in some ways, I do wonder if this was a way for this sort of like almost taco, as has already been said, was a way for Trump to sort of like take a step back on a policy that would alienate all of his Gulf allies. And in fact, as we've seen from our own reporting, like these were the guys, like, the states around the Gulf, like, who were actually petitioning him to walk this back. So.
Nicholas, great to chat. Thank you so much. Nicholas Loa, our Bloomberg oil reporter. We have more ahead on the Asia trade. This is Bloomberg.
We're seeing Korean equities surging in today's session. The best day in about a month for the Kospi, with the likes of tech, the energy sector, industrials also gaining ground. Not surprising, energy sector companies, given that we are seeing Brent prices above that $85 a barrel, again on the ongoing conflict between Iran and the U.S. But it's really to do with the volatility that we're seeing around the tech sector, right? Especially when it comes to SK Hynix stocks. I mean, the ADRs now with a premium of more than 50% to Seoul shares. But at the moment, there is a lot of expectation that the ADR flows could actually flow into the South Korean economy. So that's giving the Korean won a little bit of a boost as well. You can see it trading below that 1500 level. And we have seen also some data pointing to perhaps more tightening coming from the Bank of Korea. The jobless rate falling to 2.7%. Although propped up by government support jobs, of course, we have seen this overheating perhaps, or concerns of overheating of the South Korean economy given what's happening in the semiconductor space. But let's discuss all of this and bring in Bloomberg's Garfield Reynolds, who leads our MLive Asia coverage. Garf, I mean, there's incredible strength when it comes to the South Korea market, but also a lot of volatility.
Yeah, I was going to say the volatility sort of outweighs the strength, at least for now. Even with what's going on this morning, the Kospi remains well below the highs that we saw earlier this year. Of course, it is very strongly up over the course of the year. So that, again, highlights the volatility. And it also, we're getting another demonstration how, at the moment, South Korean stocks are essentially one and a half companies, as it were. It's Hynix and then to a lesser extent Samsung that are really meaning just about everything for South Korean equities. That's part of the volatility, and that's a big part of what's leading to gains today.
Yeah, I suppose feature not a bug. Garth, what about what this means for the Korean won? Because there's a sense of maybe, there's a repatriation of funds leading to demand for the local currency.
Yeah, that's one of the things that's gone on that's been helping with the Korean won. There's also the likelihood that the BOK will hike, as was flagged earlier. There's a broader bit of the picture going on here as well, and that one of the things that weighed on the Korean won over this year was that as you had these extreme gains for Hynix and Samsung, foreign investors were being forced to sell out of some of their holdings because they were bumping up against single stock limits with the concentration that was going on in the Korean index. Now that foreigners can buy SK Hynix and look potentially forward to buying Samsung outside of Korea, that may actually help to remove some of the structural setup that was driving at least some of that massive repatriation. We've also, of course, had a big climb down in the shares, which means it's a cleaner positioning setup. So that means we could return towards a more normal dynamic where you can have the won gaining at the same time as South Korean shares are gaining, whereas for much of this year, those were going in opposite directions.
Okay, and very quickly, Garfield, before we let you go, this whole pension buying speculation, talking about repatriation of funds, that's a big story here in Japan.
Very big story. It's also, part of what's going on is also not just the sort of direct repatriation, but efforts to encourage retail investors and also institutions to be more biased to buy, with their existing inflows. So it's a kind of a stealth repatriation, as it were. The allocations to Japanese government bonds were biased towards growing anyway, with yields higher. Now the government is acting to reinforce that. So that could lead to a flatter curve as those high, longer end Japanese yields attract more buyers there. And that would be better for the yen by at least limiting some of the outflows that would normally happen, and might also be better for the stability of Japanese financial markets.
Garth, thank you so much. We'll watch to see whether that pans out. Bloomberg's Garfield Reynolds for us there. Let's take a look at how Europe futures are faring in the early goings. Of course, the macro backdrop, whether you're looking at what's come out of the US, has improved a fair bit, but Stocks 50 futures still looking at a bit of those declines on a day where, of course, investors also contending with how the dollar has slipped a fair bit. So euro dollar is climbing just a little. We have more ahead on the Asia trade. This is Bloomberg. Let's take a look at how the benchmarks are faring half an hour into the trading day. Of course, we already saw the Kospi surging by upwards of 7%. A lot of volatility there, driven by these leverage ETFs. Of course, options out of the US as well, as we've learned, began trading this week. Take a look at how the improved, risk appetite, given the US CPI numbers, is perhaps also helping the macro backdrop overall. So you do see a bit of that tech rebound also in the Japanese gauge. Australia's ASX 200 also sitting in the green on a day where the dollar is coming under further pressure. Now, we're also watching out for China data. It will release its latest economic activity data later today. Second quarter GDP growth expected to have weakened to 4.5%, according to the median forecast in a Bloomberg survey. Let's discuss the broader outlook for the Chinese economy with Peiqian Liu, Asia economist at Fidelity International. So, Peiqian, we're expecting a bit of a slowing. What does that mean for the back half of the year?
Thanks for having me today, Avril. Yes, we're going to see China's Q2 GDP alongside the real activities data today. And we do expect a slowdown as we have observed in data from April and May. Part of that was hit by the Iran conflict and its subsequent shortages of various input. But as well, the domestic demand seems to be softened a little bit on the back of somewhat conservative fiscal stance in the second quarter. So all in all, I think we are probably going to expect some softness in data. And the key really is where does that trigger the reaction function from the policymakers?
Do you think there will be a reaction function? I think a lot of economists or China observers have said, keep your expectations on stimulus low.
Yeah, I think there's a view on that, and they do lean into that view of broad-based stimulus because overall, if we look at China's growth, even though we're expecting slowdown to somewhat a 4.5% anchor, but remember, we have lowered the GDP and growth expectations for this year to pave way for a higher quality growth. And looking at the shape of China's growth, it's currently running under two speed. We know K-shaped growth is everywhere, but K in China looks slightly different. It is a representation of the characteristics of China's transition. We do see the high-speed growth in export sector yesterday, as well as the tech manufacturing sector that's been running on a higher speed. And that perhaps stops or kind of makes the policymaker hesitate to roll out any form of broad stimulus. But that doesn't mean China doesn't need help because we do have another side of the K or the lower gear of the economy which is under transition. And we did see some slowdown, especially within the retail sales, which we are expecting some weak number today again, which is mainly driven by the slowdown of goods consumption as stimulus has been subsided earlier this year. So with that in mind, if there are slowdown resurface again in the retail sector, we do see more efforts coming in to inject some sort of targeted stimulus to support the weaker side of the economy.
There also seems to be some rumblings about a consumption support plan. How much weight are you putting on something like that?
Yeah, exactly. We did hear some follow-ups from 5-year plan in terms of implementation. The key headline numbers suggest that we're probably going to see about 3.7% of nominal retail sales growth planned in for the next few years. And that's not ambitious in my view. I think he's still along the side of accepting a slower growth trajectory while making the structure of the economy in a better shape. So in terms of consumption, more particularly in that policy statement, I think we should pay more attention to the skewed towards the services consumption altogether. So it used to be the case where goods consumption are taking the heavy weight, and it appears to be more cyclical, coming in and out with policy stimulus. But now we are probably seeing that transition more towards an institutionalized framework to allow consumption and domestic consumption at large to be the backbone of the economy to support the products or the yield dividends from tech and innovation-driven growth.
We've been talking a lot about what some people are calling the bottom half of the K. What about the AI-driven part? I mean, we had the trade numbers yesterday. Do you get a sense that even that could be vulnerable to the global capex cycle and to what AI-related investments look like in the next couple of years?
There are definitely some cyclical elements of that, but I would like to dissect yesterday's trade data into three broader perspectives to look at China's external outperformance in a broader view. Firstly, the AI part. We did see exponential growth in AI's both imports and exports, and that just reflects how deeply entrenched that AI phenomenon has been affecting China. And China is also deeply integrated in that supply chain. Given any cyclical elements of that, coming into next few quarters, if there's any risk to that, I'm sure China will be affected as well. But that is not the big picture. We also saw another aspects of China's outperformance, which mainly comes from, I would say, the competitiveness of its supply chain with regard to green tech and transportation. So if we saw EV exports, which is also continuously outperforming, and that to me reflects more of an upgrading of China's manufacturing supply chain, and that demand for energy resilience, energy security is also a decent support from a structural perspective to China's green tech exports.
But Some of these, sorry, you had another point, was there?
It's all right, just go ahead. The third point really is the easing of the US-China trade tensions that people have always overlooked. Because if we look at China's exports by country, low-end product consumer goods to US has been recovered somewhat after the peace deal with the trade truce with US.
Some of the sectors that you talked about that are underpinning the trade numbers, they're also facing oversupply, the overcapacity. Is that a headwind, or has that already been sort of accounted for?
That's always going to be a headwind, as we think that with a lot more trade frictions with the DM economies because of the rising export similarity, the rising competitiveness of China. So we're not really optimistic per se about upcoming relationship between China-Europe, China-Japan, or just broadly with the competitive industrial pact. But I think that having been said, China's exports of EV is probably going to continue to push through to a wider markets, and I think the demand is there, of course, with some frictions from the DM, but the third market competition, China is probably going to still sail through with some resilience going forward.
Talking about sailing, the latest flare-up in the Strait, how bad does it look for China? Because it was also interesting how resilient it was even during the worst of times in the conflict.
Yeah, here comes the messy part of the resolution. In our base case, we always think that the Straits of Hormuz situation is going to be a messy resolution. It's never a straight line. And now we see some flare-ups, and we are worried about that as well. Earlier this year, we did see China showing some resilience, which is basically a combination of some demand destruction, softer demand, especially in the refinery sector, as well as its buffers and inventory that has built up. But inventory is not infinite. We do think that the risk is accumulating as we move forward with more closures and more disruptions. So all we can see is that China is now running on buffers, but the clock is ticking for China as well. So if the disruption is going to last longer, we do think that China will continue to draw down reserves at the point of time while remain a sensitive margin buyer of crude oil and enter the market wherever price seems to be appropriate for them. It's not just a crude story. I would also like to flag that there are also LNG aspects of that and other key strategic inputs such as helium or key products for manufacturing sectors. So we do think that China will start to remain a little bit cautious as well as the disruption happens, but it's overall managing on kind of sailing through and managing with precautions is our base case.
Okay, Peiqian, great to get your analysis. Thanks so much for the time today. Peiqian Liu, Asia economist at Fidelity International. We have more ahead on the Asia trade. This is Bloomberg. Now, talking all things AI, China's largest memory chip maker, CXMT or Changxin Memory, is seeking to raise a near record amount in its upcoming Shanghai Starboard IPO. It's the latest in a string of semiconductor companies seeking to raise capital amid the AI spending boom globally. Our Chief North Asia correspondent Stephen Engel joins us now from Hong Kong. So, Steve, what do we know about the size, the scope of this offering?
Yeah, it's going to be pretty big because just last Friday when I was on talking about this, we were talking about an IPO upwards of $4.3 billion US dollars. So now we're talking about, based on the pricing and the size of the offering and whether they exercise the over allotment option, we could be talking about an IPO upwards of $9.8 billion. That would be China's biggest IPO dating back to AgBank in 2010. It would also be Asia's second biggest IPO following LG Energy Solutions in 2022, which raised upwards of $10.8 billion. So this is going to be a pretty big offering when it hits that starboard in Shanghai, $9.8 billion. And again, you know, this is going to be a big market test for Beijing as it really is pushing companies like this one to challenge the triopoly, if you want to call it, of course, in the memory space with Samsung Electronics and SK Hynix. Of course, they had the big ADR debut recently. And then, of course, there's Micron Technology. This is the world's fourth biggest memory chip maker and would probably be the biggest market test for China's ambitions to become self-reliant in semiconductors, in particular memory chips and eventually high bandwidth memory that these memory chip players are capitalizing on with a boom in AI spending.
I suppose as part of that push, the pride and joy of China also, DeepSeek, we're hearing that it could be leading and going into an IPO in China this year. What more do we know?
Yeah, that's right. So sources are telling Bloomberg that that could be lined up by sometime later this year. Tencent and CATL, we all know, were lead investors in this big $7 billion financing round. So this, according to sources, would be not only an IPO by the end of this year, but another private market financing round just coming weeks after. It was in June or mid-June thereabouts that we had that $7 billion financing round from the likes of Tencent and CATL. So again, this is a company that needs to spend. They feel they need to spend. They need to spend a lot on R&D, and they've said that. Senior management last month or a couple of months ago were talking about, or around the time of that last financing round in early June, they were talking about the need for research and development and AI compute far exceeds, right now at least, the immediate short-term commercialization. But at the same time, that is a theme globally. We've heard when are these large language models like DeepSeek, which was part of course, the namesake, the eponymous DeepSeek moment, when are they going to start making money for its investors?
Steve, thanks for keeping tabs on all this for us. Chief North Asia correspondent Stephen Angle. And it'll be interesting to see, given all these listings, the impact it might have on the broader markets in terms of liquidity at the time, where if you look at the Star 50, it's pulled back from those June highs. Meantime, analysts are saying that a recent sell-off in Chinese AI hardware stocks is a likely temporary setback tied to IPO disruptions rather than a lasting sector rotation. For more, let's bring in Bloomberg Asia Equities reporter Winnie Su. So, Winnie, we're seeing a bit of a pullback in Chinese hardware stocks recently. Is this part of rotation or maybe caution ahead of the Changxin IPO?
Yeah, morning, Avril. So you just mentioned it really is a bit of that caution ahead of the IPO from CXMT. Now you just discussed that with Steve. Lots of excitement ahead of the IPO, which is going to have its share subscription open from tomorrow. Now we've learned that it is likely going to raise that $9.8 billion, doubling what was initially estimated. So based on what we've seen previously in the IPOs, we've learned last year, for example, that when we saw the likes of more threats and also MetaX having their prospectus update, and until the debut, actually we saw shares falling because of some profit taking after such a strong rally into the news. So most likely this time around, we're also seeing a similar pattern because Star 50, you just mentioned, it has really rallied in the past 3 months on expectation for this IPO and the listing. So right now, a bit of a caution before that the real debut actually happens.
What else are we seeing in investors' positioning ahead of the IPO?
Yeah, so when I spoke to investors at East Spring today, for now they seems to be expecting the oversubscription and over allotment driven by the excitement for this mega memory chip maker. But interestingly, the problem here is that foreign investors don't really have access to these mainland IPOs until a few months later when they have access on the Stock Connect. So what we're hearing right now is that they are seeking proxies. So for example, the likes of banks, which are sponsors and investors of these IPOs, the likes of CICC, CSC, we saw these stocks rallying because of such expectation. And also investors like the supply chain as well. We are hearing that they are expecting the funds raised by CXMT to be deployed into the CAPEX and hence benefiting the the memory chip or the memory sector in China, and hence the suppliers of CXMT, the likes of ACM Research, in fact, jumped some 100% in the past 3 months, along with some other suppliers as well. So lots of interest as investors seek exposure to this IPO while they don't have a direct access.
So interesting. Winnie, thank you so much. Bloomberg Asia Equities reporter Winnie Su. We have more ahead on the Asia trade. This is Bloomberg. Some top corporate stories we're tracking. Warren Buffett has pledged to completely dispose of his roughly $140 billion stake in Berkshire Hathaway over the next 8 years. He's announced a new round of donations to charities tied to his family, but paused donations to the Gates Foundation for the first time in nearly 2 decades. That comes after the release of documents reigniting scrutiny of Bill Gates' ties to the late sex offender Jeffrey Epstein. A Bloomberg scoop has lifted the curtain on OpenAI's much-anticipated move into consumer devices. Sources say it's planning a mobile screen-free smart speaker designed to be a new type of home computer for the AI era. It'll help control smart home appliances, play media, answer questions, tap into the range of capabilities offered by ChatGPT. Now, one of India's most successful tech entrepreneurs is planning to launch a new health tracking device after stepping back from the empire he led for 18 years. Deepinder Goyal made his fortune with delivery apps, including Zomato and Blinkit. Bloomberg's Haslinda Amin spoke to him exclusively for an upcoming episode of Latitude.
We will launch it as a wellness device with peer-reviewed studies and everything, and we have features coming up which will need it to become a medical device. So those features, whenever we have them, we will go through the regulatory approvals and then launch those features.
Is there a time frame you think it will be ready for the market?
We're not working on a timeline, to be very honest.
24 months, 36 months.
Oh, it's not that long. I mean, I don't have that much patience. So
12 months.
Maybe 6 to 12 months. Maybe 6 to 12 months. But I've been saying that for the last 18 months. So I don't know, right? So every time I say it's like 6 to 12 months, but the deadline keeps getting pushed because we discover something new, we discover something richer inside the signal, and then we just want to make it perfect before we launch.
Also, now you have LAT Aerospace. What is that about?
LAT Aerospace is again a personal project / passion. Okay, so
what are you trying to solve?
I'm trying to solve for the hyper dense cities that we all live in. There's just too many people, and it's just too crowded. I mean, why do I live here? The reason why I live here is because we have so many people working here, and I need to be in the office every single day. But this makes our cities crowded and polluted, and so on, right? And the other thing is that our rural areas don't grow as much because nobody wants to set up factories there because it is so hard for CEOs to go there. Decongest the cities is what I really want to do, and sort of distribute wealth and work more across the country so that all of it develops at the same pace as the sort of cities are doing. That's what I want to do.
What would it take for that to be a reality? It's not just about putting $205 million into that project. What else needs to be in place for that to be a reality?
I mean, for that to happen, my idea of the answer is that we need short takeoff and landing planes, 8-seaters, running at super cheap costs. They don't need to be like as...
Super cheap is...
I mean, as good as trains, or maybe like twice of trains, like that much. That is the amount of ticket price of these planes. And you should be able to and create very small air stops in so many different cities, and towns and villages. So a hyper dense flight network is just, I mean, it's like almost quick commerce principles applied to aviation. So that's what we would want to build. It's a very hard project. I have 0.1% expectation that it will work.
Oh, yeah? It's very hard because...
I mean, we can get the engineering done. Even that's hard. Like it's very, very hard. But then the regulations, and then finding real estate, and then it's a full stack airline, right? From building planes and having your own proprietary tech, and having your radars, and having everything on your own. There's nothing
in a country that's already congested in the air as well.
I mean, I don't think there is any such thing as congestion in the air. Like air is a big wide space. So if we build a routing system which actually lets all of this fly, I think everything can happen easily.
Catch more from this conversation between Deepinder Goyal later on Insight with Haslinda Amin. We also have some World Cup news for you. Spain are into their first FIFA World Cup final since winning the tournament in 2010 after a comfortable 2-0 victory over France. Mikel Oyarzabal opened the scoring with a first-half penalty before Pedro Porro sealed the win just before the hour mark. It was a disappointing performance from favourites France, whose star attacking lineup managed just 3 shots on target. Spain will now meet either England or Argentina in Sunday's final. Quick look at how the setup is looking for Chinese markets as well. On a day where you look at Japan and South Korea, there is that follow through on the chip stock rally, but maybe some of these IT software stocks remain under pressure following what we got out of IBM. We're counting down as well to the data dump out of China that's out the top of the 10-hour. We're also watching out for potential reaction when it comes to developments related to maybe we see a DeepSeek IPO at some point. That's it from the Asia Trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. The China Show is next. This is Bloomberg.